Hey guys, how's it going? Value Venture Investing here today. So today we're going to be talking about dividends. Now specifically in this video, I'm going to be showing you something I wish I would have known in my younger years. Like when I was 18, 19 investing, that's when I started investing. I missed out on a phenomenal opportunity for dividend growth. So in this video, I'm going to be showing you, I did the actual legwork in terms of running the numbers on some historical data to show you how incredibly important it is to have at least some of your portfolio in dividend investing. I know that I'm starting to transition into that a little bit more as my portfolio grows and grows. So stick around to the end of the video to see all the money that I left on the table and that you could be leaving on the table as well, especially if you're particularly young. And I think the one at the end is really going to surprise you. So first off, what is a dividend? Now, if you haven't seen my video on what is a dividend, make sure you check that out because then that gives a in-depth explanation as to what a dividend is. I also have a video on what a stock split is. So if you want to look into those videos, look at my stock market basics playlist. That's where I'm going to be putting all those videos, and that's where I'm going to be putting this video as well. But for the purposes of this video, what is a dividend? Well, simply put, it is just money that is paid to you by a corporation that you own. When you buy a stock, you're an owner of a corporation, and it just basically comes right into your account like cash. So a brokerage account, it's like a bank account online where you're going to be looking at all your securities, and you're going to have a section where you can have cash. And if a company pays dividends, it usually takes a little bit to show up, and then it's going to show up into your account as cash. Also, you have the option to do a DRIP. That's called a dividend reinvestment plan, and that basically means that the brokerage is going to reinvest that money in shares of the same company that paid it to help it grow faster, and usually you don't have to pay commissions on those, so it's a really great thing to do that as well. I've talked about this in my other videos. You know, the economic theory of investing essentially is that investors want to buy shares in the company so that they can get future dividends. Well, I find lately a lot of people, you know, I guess it's been like this for a long time, are always looking for capital gains. I mean, this is something that I was looking for specifically when I started as well. Why do you want to hold something for 10 years to make money? It's like, I want to make money now, right? That's the nature of human beings. But you know, at its core, that's what investing is. You're waiting for a company to make money so they can pay out the dividends. So, like I said, this differs from a capital gain. A capital gain is specifically what I just talked about. The share prices go up. This is something that's paid usually quarters. So like every 3 months, it's going to go and pay it bang, 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 right? So let's take a look right now at how you actually find this dividend if you're not aware of how to do it already. Now, the best resource I find is Yahoo Finance. You can also look it up on the Securities Exchange Commission or whatever, you know, if you're in Canada, it's a SEDAR website. Whatever government agency has a specific financial statements. But Yahoo, I've never found that Yahoo has had any kind of mistakes on it. So we're looking at Apple here. This just happens to be one that I'm looking at right now. And we're looking for the past year. I believe, the first one here was actually paid in 2018, and they just recently paid another one. But as you can see, there's been two dividend payments that were 73 cents and two that were 77 cents. So that is how it's paid out, and you can see any company that you want. Just go to Yahoo Finance and make sure that you've selected dividends, and then you're able to see, when they've paid, how much they've paid, etc. Okay, so the next thing we're going to be talking about is, before we even get into any of this, is you want to find a company that pays a dividend. And some companies pay extremely high dividends. But the question always is, well, how do you know that this company is going to be able to, continue to pay this? Because you're going to see the amount of money they're going to make here soon when I show you my calculations. So one of the best ways to do that is something that's called the payout ratio. Now, what is the payout ratio? It's really kind of simple. It's just basically here, or literally rather, the dividends paid. So like, that's just what I showed you. Usually it's expected dividends in the future and expected earnings in the future, but we'll just use a historical. We'll go trailing 12 months past. So basically what you saw was Apple. We just saw the 4 there. The dividends paid, and you're going to divide that by the EPS. Again, this is expected earnings for the next year, but in this case, we can just do the last 4 EPS for Apple, and then you're going to basically get a number that's going to be percentages. I think Apple's, we're going to look at it here, somewhere around 25% or something. So then I can show you. So the lower the number is, obviously, the better it is. If it's an extremely high number, you're going to have to look into why. How are they doing that? And that's getting a little bit more advanced, something that I'll teach you guys a little bit later. So how do you find this dividend rate payout ratio? Well, again, just look at Yahoo Finance here. If you click on the statistics spot, there's a lot of useful information here. And if you go down to dividends and splits, you can actually find it right here. The payout ratio, I was about right, about 25.33%. And then you can actually look at the other numbers that they have here to find out how they've actually calculated it. We can see the forward annual dividend rate, that's $3.08. And if you look over under the income statement, you can see the diluted EPS of $11.89. So basically you divide those two. I'm not too sure if it's using trailing or going forward, but that's how you do it and that's how you find it. If you are more interested in looking for it for yourself, again, you can go to the Securities and Exchange Commission website. I showed you guys how to do this on my other video on how to look up financial statements. The reason I chose Apple here is because they have a 10K, meaning it's the last 4 quarters. It's showing it for the year. Otherwise, you're going to have to, if you want to find these numbers yourself, you're going to actually have to go and look at every quarter and find those numbers. So we click on Documents here. We look at the 10K. And there's a bunch of stuff that we got to scroll through here to get down to their actually income statement related area here. There's a lot of information in these annual reports. So this is something else. This is good information. So if you can see selected financial data, we have earnings per share. There it is right there. Diluted for 2019 was $11.89. That's what we saw on Yahoo. And then EPS was, we're EPS right now, sorry. And then if you're looking at the actual dividends paid per share, there you go, $3. And I think the forward ratio was $3.08 because of course they're expected to increase it. So like I said, you're looking for the future payout ratio because you want to know, how sustainable is this into the future. Okay, so now we're going to actually look into why do you want to do this? Why is this important? Why don't you just want to, buy Tesla at $350 right now and sell it at $400? Okay, you got to have a time horizon on your hand, obviously a long time horizon. You got to be looking for future growth. So let's take a look at a spreadsheet that I made right now. Now this spreadsheet is 3 companies. I literally just pick these off, just companies that I happen to be looking at. The first one that I picked here was Coca-Cola Company, just as it's, kind of a company that hasn't really paid like huge dividends. I did Chevron because that's kind of known as a company that pays dividends, and I did another one, Fortis, just as it's something that I've owned that I bought probably about 6 to 8 months ago. So this might look a little confusing, but don't worry, I'm going to explain it. It's really simple. Here we have date. So this is roughly 19-20 years, so like a long-term hold. See, this was in 2000. In this column, I have the price. In 2000, about January, I started at the beginning of the year, it was $30.38, and the year dividend was 68 cents. Again, like I showed you guys just shortly ago here, how to find that dividend. So this is what it paid: 1 quarter, 2 quarter, 3 quarter, 4 quarter. So that's what you get for the year if you own the company, and you can look back and confirm that yourself. So the value of the dividend was $223.38. Well, why is that the value? Well, hypothetically, for all of these, I said a $10,000 investment. Well, this isn't exactly $10,000, and that's because you couldn't exactly get it at this price, so you could get 9,980, right? So that gives you 329 shares, right? Simple math, 9,980 divided by 38, you're going to get, as we can see here, 329 shares. So that's giving you $223 a year. Kind of boring, you're thinking, for a $10,000 investment, but stay with me here. The yield, this is not that important, but it's something I kind of like to look at. This is the yield for how much you've invested, what dividend you're getting, right? So as the years go on, your yield, it depends, is generally going to go up, right? because you're getting $223 here for a divided by 9,980, and that gives you a yield of 2.24%. So that's what it was paying at the time, not too bad. So at the beginning of the year, that's what you have. Now, you've received this dividend throughout the year, right? As you can see here, the share price has gone up because what we're doing is we're reinvesting that dividend into the company. So if you look at what I've done here, you've taken the 329 shares that you have times the dividend, sorry, you're not actually times the dividend, you have the dividend here. And that money that you received as a dividend, you are now investing in the company. And I did at the beginning of the next year, the same date. So at the beginning of 2001, it was $30.41. So you can now buy, as you can see here, D3, which is 223 divided by $30.41. That gives you a certain amount or more of shares, and you add it to what you had before. So now instead of 329 shares, you have 336 shares. I hope that makes sense. You invested this money and bought more shares. Of course, you could do this at any time. You could do it after every dividend that you got. If you had a drip, that certainly might be the case. But here, just for argument's sakes, I said you kept that money all year, you did nothing with it, and you reinvested it at whatever price it was at that beginning of the year. Now these were the yearly dividends, 72 cents, because usually companies are upping them. And here's the dividend that you had, the yield, and now your position is going to 10,213. And again, I did the same thing every year. So you're increasing your value, and all you're doing is you're not buying any other shares with any of your money at all. You were just reinvesting that dividend. So if you want to get a better idea of what I've done here, just make sure to, freeze the screen, take a look at it, because as you can see, look at the value increase. By 2019, this is as of November, so 3/4 of dividends here, and this is approximate the price. I think this is the price as of yesterday. You've paid $44,000 in that time. So that's pretty incredible. This is the part that I really want you guys to look at here. So here was your investment, right? Your return excluding dividends. So this is what I'm talking about before. This is people that are just like, I want to buy this company and I want it to increase in value. If you would have taken these dividends and just bought a new iPhone every year or did whatever you did with them, you would have made $17,000. 70%, that's pretty good, right? But look what you could have had, $44,000. So again, you had $19,801 in dividends. I've summed this up at the bottom here so you can see what difference that made. So your return, so that's this, plus the dividends was $36,830, which is 269% growth. So you can see the huge difference. However, instead of taking, like in this case, you got the dividends and you're assuming that you just did nothing with them and added them to what you got on the capital gain here. But if you reinvested it, instead of just holding that dividend, like we showed, it's $44,006. So that's a difference of $7,176 by reinvesting it and not doing anything with it. So that's 340%. That's pretty massive. I did one other calculation down here. You can see the difference without the dividend. So what this is you can see it's the total return we would have had reinvesting it minus the original return. It's just spending the dividend. So that's even bigger, 26,977. This is Chevron. If I can go to it here. Again, exact same thing. It's a $9,000. This one's closer to a $10,000 investment. If you didn't, take those dividends, worry about those dividends, blow them, you would have had 188%. So your 10,000 would become 28,000. But if you would have got those dividends, that would have been 19,000, almost $20,000. So the return plus the dividends is 48,000. But if you reinvested that, that would be 53,621 on a $10,000 investment. That's 436%. So you can see the differences are huge. The difference again here, as you can see, I'll highlight so you can see between just getting the dividend and reinvesting the dividend was 4,800, and you have a $24,000 difference, reinvesting the dividend versus just the return here. Fortis, this is one that I included, and it really actually surprised me. I started buying this a while ago because I think this is a phenomenal company. It's a gas and electric utility company based out of Canada, but it's on the New York Stock Exchange as well. But this is the Canadian one, and I did the Canadian one because the US one isn't as long. They didn't get listed on the US exchanges until, I'm not too sure, I can't quite remember, I'd have to look, but they didn't go back to 2001. Again, $10,000 investment, and if you just simply looked at the return, that's pretty crazy anyway. 560%, you would have made $66,000. So in terms of just a company that increases in value, that's amazing. But look how many dividends you would have gotten. $86,836. So if you sum those two, that's $152,000. That's 1,429% gain. However, if you reinvested that, look at this. This one blew my mind. Remember, this is off $10,000. $232,000 and $72. Look at this, 2,221%. So the difference here is pretty massive as well. If you look at this, if you just took the dividend and did nothing with it versus reinvesting it, you're leaving $80,000 on the table almost. And of course, the difference of just not having the dividend at all is $166,000. So this is the key line I want you to look at right here. It may not seem that amazing to be getting, this many dividends, although this was a high yield. As you can see, in 2001, it was yielding over 23%, 28%. I'm not too sure how sustainable that was, but obviously being a government-regulated utility, you can take that into account, and you could have, anticipated that would have been okay payout, but huge. Look how your money has grown here. It's absolutely phenomenal. So as you can see, it is incredible. I mean, the compounding effect of dividends. Some companies are better than others. I mean, you could have invested in some companies that had huge capital gains, but if you don't have a section of your portfolio that is invested in a high quality, high yielding dividend, you're going to kick yourself, in 10 years, 20 years, longer. Hopefully you're an investor for longer than that, right? So this is something that I've been transitioning my portfolio into a little bit more, becoming a little bit more defensive, because if things do go sideways, then you're still getting that dividend. You don't really care what happens with the share price. It's just compounding and compounding and compounding. And of course, if the share price goes down, it gets even cheaper to buy even more. Not that I think that that's going to happen. There's not really any evidence that I can see that we're going to see the stock market pull back huge. Like I said in my other videos, there usually has to be a reason. It doesn't mean that it's not going to happen, but it still doesn't hurt to become defensive in terms of your portfolio getting bigger and investing more in dividend paying stocks. And this is just 3 examples. I just pulled these out of nowhere and I did these, and I hope you guys really appreciate the work that I put in to just show you guys, because a lot of people wouldn't go through and they wouldn't actually look at these numbers. They would just kind of go, oh, this is how many dividends I would have got, and they didn't think about reinvestment and compounding. So guys, super important. I'm going to start investing more and more in dividend stocks. I have been for a while. If you like what I did here, please give the channel or the video a like, subscribe to the channel, leave a comment down below if you want. Really helps the channel. So that's going to be it for you guys, and I'll see you in the next one.